Hello everyone, my name is Kevin Carlson. I'm a mortgage broker here in Canada. Thank you so much for joining me on my channel today to learn a little bit more about mortgage financing. Of all the challenges that first-time homebuyers face over the years that I've seen, it is down payment. That is the one thing that is the most common that first-time homebuyers found challenging. Here in Canada, the minimum down payment for the purchase of a home for you to live in is 5%. Being able to come up with your down payment funds is not something that comes easily to absolutely everyone. You must put a plan in place to be able to put funds away to be able to save up for your down payment. This is especially difficult for those people that are living out on their own, not living with mom and dad, and paying rent and utilities of their own. First, let's go over some of the rules and guidelines around down payment when it comes to mortgages. The Canadian federal government has put some rules in place in order to track where down payment funds come from. This is to prevent money laundering. Now, money laundering is when you use the proceeds of the sale of illegal criminal activities for the purchase of a house. So when it comes to putting down payment down for the purchase of a home, it's not just how much you have, but where those funds come from. Down payment funds typically come from savings or investments. So you'll have to show your previous 3 months of bank statements or investment statements showing that you've had these funds for at least that 3 to 4 month time. Any deposits to your accounts over that time that is not clearly payroll does have to be explained and tracked. You may need to provide follow-up documentation to explain where those extra fund deposits came from. If you are receiving money from a family member as a portion or all of your down payment, that is certainly allowable. But it must be from an immediate relative, so mother, father, sister, brother, or a grandparent. Extended family and friends or even your employer is certainly not allowed. It must be an immediate relative. These funds need to be considered as a gift with no repayment required. So both parties, the person that's giving the gift as well as the person that's receiving it, will need to sign what's called a gift letter to verify that it's being given as a gift and that there's no repayment. So what happens if you don't have your 5% down from these sources that I've mentioned? You don't have enough savings, you don't have any investments, and you're still looking to purchase a home. Well, there are some options out there. You may have heard the term zero down mortgage. Well, up until a few years ago, zero down mortgages were a thing. That was a widely used mortgage product. I did plenty of them. But those mortgage products are no longer available. 100% financing or zero down mortgages really aren't a thing. If you'd like to learn why those zero down mortgages went away, I did another video on the changes in the mortgage industry over the last 15 years and why that sort of a product isn't available anymore. I will link to it in the description below. Go and have a look at it. It's fairly interesting. If you don't have access to the traditional down payment funds and savings or investments, or you don't have a family member that can gift you some funds, there are still options available. The flex down or borrowed down payment programs still act like the zero down programs, but they aren't called that. Under the flex down or borrowed down payment programs, you're allowed to borrow the down payment funds from a line of credit or from a loan. Flex down and borrowed down payment is basically the same term for the same product. For this presentation, I'll just say flex down because that's kind of the term that the industry uses. Well, this flex down program certainly sounds too good to be true, and if that's what you're thinking, well, you're right. There are some pretty strict criteria to be able to be approved for a flex down mortgage. So let's go over some of those. Your credit must be seasoned and impeccable. You're going to have at least a loan, a couple of credit cards and that sort of thing in your name for at least 3 to 5 years. If you've missed any payments on any credit items over the last, say, 12 or 24 months, that could take you out of the running to get a flex down mortgage. These lenders are going to be looking for absolute credit perfection for a flex down mortgage. Your income must be solid and stable. So if you're in a casual or a part-time or a seasonal job, that's really not the type of client that they're going to be looking for. If that's the case, you're going to definitely at least have your minimum 5% down payment of your own funds. If you are permanent and full-time at your job, whether you're salaried or paid hourly, and you've been with the same employer for at least 3 to 5 years, that is pretty much the ideal client for a flex down program. They're looking for good, solid, stable income that isn't going to cause any troubles down the road. even though you're getting your down payment from a line of credit or a loan, you're still going to have at least a little bit of savings. Typically, the lenders are going to want to see that you have enough to cover what's called the closing costs. Now, these are the legal fees and land titles transfer costs that all Canadians pay for when they purchase a home. Now, the lenders here in Canada, they use a 1.5% of the purchase price as a high watermark all across Canada. So they just use that as an estimate no matter where you live. You're also going to need to demonstrate that you can afford the payment on the line of credit or loan that you're taking out to access the down payment. Now, the loans can vary based on interest rate and the term of the loan, so the payments are a little bit, kind of move around a little bit, but with a line of credit, it's typically 3% of the balance is what we have to use. So if you're taking out a line of credit to get your down payment funds, then we need to use 3% of the full drawed amount that you're going to be using for your down payment. So it's for that reason that somebody who's been pre-approved for the purchase of a home with a flex down actually gets pre-approved for a little bit less, because you have to demonstrate that you can make those payments on that extra credit item, so it's going to knock down your pre-approval. So just for easy numbers, let's say I'm doing a standard purchase mortgage with somebody who's got a down payment in their RSPs or in their savings, and they've come to me to get pre-approved. So based on their income, I'm able to pre-approve them for the purchase of a home no more than, say, $250,000. Now, that same client, if they didn't have access to the down payment funds and they were getting a flex down mortgage, then they would actually only be pre-approved for $225,000. So the extra little bit of payment does knock down the amount that they can borrow. That's not the only downside for the flex down program. If you're purchasing a home and you're getting a mortgage under flex down, then the mortgage insurance premium, or commonly known as CMHC fees, the percentage is a little bit higher. It isn't a whole bunch higher, it's only higher by 0.5%, but it does add up. So on that same previous example of $250,000, that's an extra $1,100 added to your mortgage just for going through a flex down. The good news with this flex down program, though, is that your interest rate doesn't have to suffer. So you get the same interest rate for a flex down mortgage as you would for somebody getting a mortgage with their own down payment funds. So no downside when it comes to long-term debt on the mortgage component. So I've gone over some of the downsides with the flex down program, so let's go over some of the upsides. The primary one is that you get into the real estate market sooner, and there can be a big upside to that. It depends on what the real estate market is where you're looking to buy. If the real estate market's staying fairly level and while you save up your down payment, the purchase price of the house that you're looking at hasn't really changed very much over the time you've saved, well, there's not really much of a downside there. However, if the real estate market goes up by even only 2%, so that $250,000 house now, after you've saved it up, is now $255,000. So an extra $5,000 is what you're paying for the house, and you certainly haven't paid that extra amount on the flex down mortgage unless you don't pay the debt off in a timely manner. You could end up getting a much lower interest rate if you purchase under a flex down now rather than waiting until you've saved up. So if you wait 2 years, say mortgage interest rates go up by half or a 3/4 or even a full percentage point, well, your savings really isn't there at all. You're going to be paying much more on interest in the meantime rather than taking the flex down and paying a little bit extra for that. Another benefit is stop paying off somebody else's mortgage. Why not pay off your own? Getting into the real estate market and having your own mortgage and your own house and paying off your mortgage is a far better plan than paying off somebody else's for 2 to 5 years while you save up your down payment funds. The sooner you purchase a home and you start paying off your own mortgage, the younger you will be when you are mortgage free. Thanks for joining me on my channel today to learn a little bit more about mortgage financing and zero down mortgages. If you live in Canada and you're looking for some mortgage financing, I would be more than happy to help you. Please contact me through my website, which I'll link to below. If you clicked on this video and you're trying to learn a little bit more about zero down mortgages, you might be interested in a couple of other videos on purchase and purchase plus improvements mortgages, which go well with this video. I will link to those in the description below as well, so go take a look. They're fairly informative. If you found this or any of my other videos informative or helpful, I would encourage you to like, subscribe, comment. Any interaction in my videos and in my channel is a big help, so I'd really appreciate it. So once again, thank you so much for your time and joining me on my channel, and have yourself a great day.